Well, thank you very much for your interest tonight. There may be, or there will be some of the slides which cover similar ground to what Roland's just covered, but I'm going to cover three key things. One is looking at the overall UK small company space and reiterating that strong long-term historic outperformance and looking at some of the reasons behind that. Secondly, I'm going to talk about our approach to investing in small companies and give you a couple of stock examples. And finally, talk about the performance of the investment trust that the Invesco Perpetual UK Small Companies Investment Trust, its long-term track record. Well, this chart will be familiar. This is the same chart that Roland showed you just now. So again, the bottom line, the blue line is the FTSE All-Share, so a strong performance, 11.4% compound annual return. That's with dividends reinvested. And the numerous small companies, and that's the bottom 10% of the UK market, 3% outperformance of the FTSE All-Share. But one of the questions is, has this just been a few good years, or has this been a sustainable outperformance? And so what we're looking at here is rolling 5-year performance of small companies compared to large. So if you're above the line, small companies are outperforming large. If you're below line, small companies are underperforming. And you can see, going back as far as the data goes back to 1959, that by and large, if you're taking a 5-year investment horizon, you've been better off investing in small companies. What happened here, though, is that you saw outperformance, or you saw decent performance by small companies. There was positive returns, but this was largely a period when large companies performed strongly. And if you looked at the sectors that performed strongly over that period, oil stocks performed very strongly. You had telecom stocks. It was the time when there was excitement about mobile telephony and the internet. Pharmaceuticals were, again, a loved sector. Glaxo was trading on over 20 times earnings. And also you had a lot of the demutualization. So you had the IPO of Halifax, and you had the IPO of Abbey National, and all of these sectors, banks, pharmaceuticals, telecoms, and oils, are all sectors that are much more highly represented within the large company sector than within small companies. So this period was a case of large outperforming small rather than small per se performing poorly. And putting it in this is looking at the Investment Association 10-year stats for sectors, looking at all of the sectors and different asset classes. And what you can see is that down here, at the top end, UK small companies are the third best performing sector in the Investment Association. We have been outperformed by tech, and we all know what's happened to the FANG stocks. And we've also been outperformed by US smaller companies. And this outperformance of small versus large is not just a UK phenomenon, it is a global phenomenon. And so you see that European smaller companies are the fifth largest, Japanese smaller companies are the sixth largest, sixth best performing sector in the Investment Association over the last 10 years. Some of this is Roland's already covered. Small companies are less well researched. If you look at the average sub £500 million small company, it's covered by, on average, 1.4 analysts. That tends to be the house broker and maybe one other researcher. It might be some paid-for research, which compares to 30 for the likes of BP. One of the important factors, we believe, is the ownership of equity by management of small companies. So if we look at the trusts that I co-manage, our average equity ownership is around 7% of the fund. So these are management who are thinking much more as equity owners rather than just employees of the business. And they're taking decisions with a much longer term perspective. And finally, you can get exposure to faster growing niches. Looking at our investment approach, we are fundamentally bottom-up stock pickers. We're investing with a long-term investment horizon, so our typical holding period tends to be 3-4 years. But there's many stocks in the portfolio that I've known for and invested in over 5-10 years. We have a growth focus to our portfolio, and we also run a diversified portfolio. We've got around 80 holdings in the portfolio. That means that we've got sufficient diversity to alleviate some of the liquidity issues you have with small companies, but at the same time, we've got enough, we have conviction in our top holdings. So our largest holdings, typically 3-4% of the fund. And we carry out a lot of detailed fundamental research. As you've heard, these stocks are not well covered. So we conduct over 350 company meetings a year. That tends to be one-on-one company meetings. We'll go out to sites. We'll do a lot of detailed research on the report and accounts. We'll look at things like the accounting policies. We're looking to try and find businesses who are addressing attractive and growing marketplaces. We want businesses that have got high returns and that to make sure that those returns are sustainable. So they've got barriers to entry, whether that's through brand or patents. We look for businesses that have got not only strong profits, but that profit is converted into cash. And finally, we look for businesses with management that we know and trust. And I've been investing in the space since 1995, so I've met a lot of management teams. I know which management teams have made me money. As I said, we are bottom-up stock pickers, but we do have a number of themes running through the portfolio, and this is driven by a number of overarching beliefs. One is that we're going through a phase of subpar economic growth, and the reason behind that is twofold. Firstly, demographics, that within the developed world, we have an aging population, so there will be less people driving that economic growth. And secondly, there are still high levels of debt within the developed world. Governments have a lot of debt, consumers have a lot of debt. So what that means is we're looking for businesses that can grow irrespective of the economy. And we've got 4 key themes that we've invested in. The first is self-help and recovery stocks. And these are businesses that are fundamentally good quality businesses, but for whatever reason have come on through more difficult times, and where we see a catalyst for change. More often than not, this is a new management team who can come in, restructure the business, make acquisitions, and make disposals. The second theme is what we call roll out and roll up. A roll out is a business that has a successful franchise that it can roll out either within the UK market or internationally. A roll up is a business that is consolidating a fragmented marketplace. The third theme is structural growth. And many of these are technology-driven businesses. So you've got a business like Boohoo. They're one of the market leaders in fast fashion, and they're retailing exclusively through the internet. And they have shown phenomenal growth. And finally, we have a core of what we call GARP, growth at a reasonable price businesses. These are businesses that are strong businesses, they're cash compounders. Got a couple of case studies to add a bit more flesh to what we look to do in our investment approach. Now, Future PLC was a traditional magazine publisher, very much focused on the technology space and in the computer game space. That is a sector that has been in structural decline. The reason that we were interested in Future is that there was a change, there was a catalyst there was a change of management, and there was a management team who came in from Auto Trader, a business that has successfully transitioned from a traditional print business to an online business. And what management were able to do was to put that content onto the web And so if you're searching for, say, best laptops, one of the sites you may come to is a site that Future run called Tech Radar, and it'll give you detailed reviews on all of the best laptops. They've transitioned the advertising from print online, so you'll have Samsung, you'll have Dell, you'll have HP advertising at the side of the page. But importantly, they've also, at the bottom of the reviews, when you've chosen your laptop, they will show you a list of the best, the cheapest place that you can buy that laptop. And if you click through, they will earn a commission on that transaction. So they've transformed the business from a traditional business that was in decline through traditional print media onto something that's exploiting the internet. And what you can see is that from when management came involved in the business in 2015, this is the earnings per share, there's been strong organic growth, and that's by, as I say, exploiting the internet. And that's been compounded by acquisitive growth. And they've been able to acquire these traditional assets on very low ratings. And that growth has been reflected in the share price performance of the stock, which is both the earnings growth and a re-rating as this story has got better known rather than as a traditional business in decline. It's a growth business. The next example I won't dwell on because it's a great minds think alike. For imprint, these are the products, you've heard about it. I mean, what I would highlight is that despite being number one in the US market, its market share is still only 3%. So there is still a lot of potential growth to go with the business. And it's interesting, one of the areas that for imprint capture new customers is through search engine optimization, through the likes of Google. And Google came to for imprint earlier last year saying, within every sphere on the internet, there tends to be one name that you go to. So if it's for business cards, you'll go to Vistaprint. For promotional products, there's no one that has actually captured that mindset. And Google felt there was an opportunity for imprint to take that space, which is interesting because from a Google perspective, this is taking away revenue that they would otherwise have earned on paid for search. So for imprint have been doing advertisements on TV and radio, and that has boosted their new customer and their existing customer growth rate. So there's a reason why we think this growth can both continue but accelerate. What this chart shows is how much the UK earnings have been derated. So this is looking at global indices and has derived the implicit valuation that the indices are putting on revenues and profits from the US on the pink line and the UK on the blue line. And what you can see is the pink line is broadly those earnings. There was a collapse at the end of last year, as we know, but that's largely recovered. But since the Brexit vote, UK earnings have been systematically derated by the market. Looked at another way, this is a FTSE small cap index. We're trading some 20% below our long run average. And finally, just want to talk about the slide on the performance of the trust. So here we have the pink line being our benchmark index, the blue bar being our NAV performance. So we've done what we said on the tin. We've outperformed our benchmark. And the dark blue line is our share price performance. And there's been an excess performance over the NAV as the discount on the trust has narrowed. And this is, again, the long-term or 5-year track record. Over the last 5 years, we've outperformed our benchmark, and in all bar one of the years, we've outperformed the FTSE All-Share. One of the unique factors of trust is around 4 years ago, we implemented what we term our enhanced dividend policy, which means the trust is now yielding over 4%. It's a quarterly dividend. We pay out 100% of the income the portfolio generates, and then that's supplemented by a small payment out of capital. Importantly, there was no change to our long-term investment approach, but what it has done is it's narrowed the discount from around 11% pre the implementation of this policy to around 5% today. So in summary, I hope I've persuaded you that small companies historically have produced strong outperformance, that small companies are looking cheap relative to history, and that they are an unloved asset class, and that we have strong performance that has delivered outperformance against a strong performing index. Thank you.